Ladies and gentlemen, good day and welcome to the Sundrop Brands Limited Q1 FY26 earnings conference call hosted by Anand Rathi Share and Stock Brokers Limited. As a reminder, all participant lines will be in the listen only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajay Thakur from Anand Rathi Share and Stock Brokers Limited. Thank you and over to you, sir.
Thanks, Shruti. I welcome you all to Sundrop Brands Q1 FY26 results conference call hosted by Anand Rathi Shares and Stock Brokers. From the management side, we have with us Mr. Nitish Bajaj, Group Managing Director, Mr. Ashish Sharma, CEO and Executive Director, and Mr. KP Srinivas, CFO. Now, without much of an ado, I shall like to hand over the call to Mr. Nitish Bajaj for his opening comment, followed by the Q&A session. Over to you, sir.
Yeah, hi. Thank you, Ajay, and good morning all. Good afternoon all as we speak. Welcome to Quarter 1 update earning call for the Sundrop business. I hope all of you have downloaded the presentation. What I will do is I'll keep referring to the page number and talk through the presentation so you could relate to the data and numbers I'm speaking as you flip along the presentation with me. I'm now on page number 3 of the presentation. Just a quick recap about our business fundamentals, our vision mission. When we embarked on the journey of Sundrop Brands as a food platform, we set a new vision and a mission for the organization. We are now on that path of building this organization in line with our vision and mission. Our vision remains to bring joyful food experiences to the evolving modern consumer, and we would continue to do this through giving innovative, delicious, and convenient packaged food solutions to our consumers, and in the process create strong value for all our stakeholders. Coming to page number 4, the entire thesis of this organization is to build a very scaled food platform. Sundrop Brands, historically or let's say earlier formerly known as Agrotech Foods Limited, was operating in select spaces in the packaged foods industry. With the acquisition of Del Monte Foods, we have significantly expanded our footprint in the food segment. And this, we believe, creates a scaled food platform for us with a significant profitable growth opportunity. Where we stand today, we operate in multiple categories. I'll take you through them, but we are present in categories which are growing very strong and also have reasonably strong margin profile. Overall, as we embark on this journey, we are going to invest significantly on our core portfolio for accelerated growth. We are also looking substantially to invest and up our ante in emerging and fast-growing channels, and you will see that as we go through our presentation. There is a significantly enhanced focus in the organization on improving EBITDA and PAT margins, and I'll talk you through the journey of last 1 quarter. Overall, in the long term, our approach will remain, as we have talked earlier also, on a capital-efficient approach to building scale. And we would stay, while we drive organic growth, we would stay open to any opportunities which are lucrative to build our platform further and give it a greater scale. Coming to page number 5, as you are aware, today we are a platform of very large market-leading brands, and we have 3 key brands in the portfolio. 2 of these brands are global brands, Actu and Del Monte, for which we hold a perpetual license for India subcontinent. And one, of course, Sundrop, is a brand which got created within India itself, and we have a trademark for that across the globe as a brand. So these 3 brands really give us a powerhouse or ammunition through which we can build our platform to even greater heights. Coming to page number 6. Today, as you can see, our portfolio with the acquisition of Del Monte Foods has become a very large and diverse portfolio. Earlier, we were dominantly present in staples and snacking business, as we call it. So we had, in the snacking business, we had F2 as a lead brand, where we were giving convenient packaged food snacking solutions, both in-home and out-of-home consumption. And we, of course, had a very large edible oil business under Sundrop brand, which we were expanding to get into other value-added food offerings like oats, etc., oats and breakfast cereals. With the addition of Del Monte to the family of the company, we now have a very large culinary portfolio, which is a mix of mayonnaise, tomato ketchup, and lots of spreads, in addition to, of course, the Sundrop peanut butter spread, which Sundrop had. So our culinary portfolio has expanded with the addition of Sundrop peanut butter. And then we, of course, under Del Monte, we have an entire Italian portfolio, which is a combination of pasta, olive oil, pizza and pasta sauces, and also olives, dry olives to consume on the go. Overall, if you look at, and I'm now moving on to slide number 7. Overall, if you look at, there are quite a few emerging mega trends in the food segment. And this portfolio, as we have talked always, really addresses all the trends we are seeing in the packaged food industry. So the increased need of convenience, shift towards healthier alternatives, getting exposure to globalized or new tastes across the palette, not only just Indian palette, but also evolving and getting into Western palette and European palettes. We do have solutions for each of these. There is, of course, a shift towards organized and packaged foods market versus, let's say, a loose staple market and a very fragmented retail universe. We are seeing consolidation happening, either in the form of modern trade, which started about 2 decades back, and now the e-commerce, which started about a decade back. There is an increase in in-home consumption of packaged foods. There is, of course, premiumization. Consumers are open to trying value-added premium products in this segment. There is also a lot of out-of-home consumption because today's consumers are much more mobile and eating out often. So there is shift to also consuming significantly out of home. Sustainability and concern for environment is increasingly more relevant in the times we live in. And last but more important, one of the more important trends and more recent trends is the rising consumption of protein in the diet. Coming to slide number 8, and this some of you would already be aware, we have talked about in the past presentations also. With the combined food portfolio, we today have a very strong distribution network in the organization. We cover pan-India geographies. We also do have a business in Bangladesh and opportunity to expand into other Indian subcontinents. We have expanded our business to cover all modern trade channels. So we have a very strong footprint in all direct modern trades and also all standalone modern trades which exist in the retail environment. With the emergence of e-commerce channel, your company has kept pace and also made sure that we are present in all e-commerce portals in a very strong way in both organizations. Our total retail coverage has now expanded to almost like 500,000 outlets, which we directly cover. As a combined platform, we have about 1,800 distributors, which help us reach these 500,000 modern retail outlets, plus the modern trade, standalone modern trade and e-commerce. And put together between two organizations, we have 1,700 strong field force. In terms of manufacturing footprint, as you can see on the slide 8 itself, we do have presence across India. If I look at from a northeast, west, south perspective, we have a footprint which exists in all the geographies and well distributed to cover the entire Indian market. We also have a plant in Bangladesh, which helps us cover Bangladesh market. Put together, we have 9 manufacturing facilities, and we would have our coverage within a 300-kilometer radius through one of our plants. And that is very important parameter for our snacking business, which does require a well-distributed manufacturing setup. Now moving team to slide number 9 on our Q1 update, our quarter one update. I know all of you would have been waiting for this. We have had a very strong start as a food platform. This is really the first quarter in true sense as a combined platform for us, because Del Monte acquisition got completed in the month of February. So this is the first full quarter as a combined entity. I am very happy to share that we have done well, and we have grown at 12% ahead of the industry growth rate. FMCG or food industry, are growing in upper single digits. We have been able to do better than the industry and are growing at 12% in quarter one. What is also important to note is, and I talked about it, that we will focus on evolving emerging channels. We have invested on growth in e-commerce, and as an outcome of that, we are growing substantially faster than industry in e-commerce market, growing at about 42%. In the business, we have seen in this year commodity pricing not really easing up. So commodity environment has been inflationary in quarter one. We have also had inflation in commodities, but dominantly those inflations we have been able to manage or ensure that we substantially cover the increases through increasing the prices or grammage reductions. So our material margins are more or less constant. But having said that, we have worked significantly on the side of operational efficiencies. We have worked on the side of our manufacturing costs, our logistics or supply chain costs, and also looked at our SG&A much more cohesively. As of now, still the two companies are running independently, but we have looked at making sure whatever we can bring in form of efficiencies in our operations, we do bring in. And as an outcome of that, we have seen, despite a flat material margin, we have seen a 110 basis points expansion in our gross margin. In our stated endeavor and approach to drive growth, most of this expansion in margins which we have delivered, we have deployed back for consumer acquisition and growth of our business. So in this quarter, we have substantially upped our marketing investments. Our A&P has grown significantly at 58%. And as an outcome of this, we are seeing accelerated growth coming in the business. We have also invested a little more on our expansion of coverage, and we have added about 11,000 outlets in this quarter versus last year, same period. And overall, as an outcome of this growth in business, improvement in margin, deploying it back for consumer acquisition, we have also delivered a 9% growth in EBITDA. Our EBITDA is more or less in same lines as it was in the previous quarter last year. Overall, if you look at our fundamentals are strong. Our net worth as an organization is about 1,444 crores. We are a debt-free company. We have no borrowings, and we have a free cash balance to make sure that we have sufficient liquidity to fund our capexes for growth, which are generally more now in maintenance in nature, and also our growth ambition. If I dive a little deeper into the two businesses, Sundrop, which is almost 56% of our total contribution, has delivered a turnover of 208.5 crores, growing at 15% over last year in quarter one, versus our last year growth of 5%. So we have accelerated the growth momentum in Sundrop. Del Monte, you are aware, the acquisition only got completed in February. So it is really the first quarter where we have upped the ante. We have seen a strong growth of 8%, which, if I context it with FY25 growth, is marginally lower, but we are fairly confident that as we continue our investment journey, we will be able to accelerate this growth in line with the numbers we are expecting to see on Sundrop. So there is clearly a momentum we are seeing in the business with our investments, and some of them I'll take you through ahead, which gives us a greater confidence on number ahead for Del Monte as well. Put together as a group, we have delivered 372 crore turnover, grown at about 12% in quarter one, and this you can context or contrast with a growth of 8% in FY25. Moving on to slide 11. Now, this is where our core categories are, where we invest. Now, important to note that in Sundrop, we were investing on foods platform significantly. So we stay committed to invest on our popcorn, snacking business, peanut butter business, and breakfast cereals. We have also talked about that on staples or oil business, we will do certain experiments to establish a model for growth in the future. As we set into journey ahead, these experiments will take off, and based on that, we will take a call on a longer-term positioning for our oil business. As of now, our ambition is to ensure oil business is managed at protecting the volumes, but based on successes in certain investment theses which we are putting, we will take a forward call later, and we will share with business with all of you at an appropriate time when we have a stronger or a deeper view on how we want to build the oil business. In the Del Monte portfolio, our focus will be on culinary, which is ketchups and sauces and mayonnaise, and on Italian range, which is a mix of olive oils, pastas as a business. So staying to these core categories where we have been investing over last few years, and of course we have upped the ante in the last quarter, we can see that there is a significant growth happening through these focus categories, and contribution of these focus categories in the business have moved in last 2.5 years, or little less than 2.5 years, from 53% to 61%. Moving to slide number 12, we are also seeing a very strong growth, which is in each of the core categories. So just to nuance it for you, our popcorns and snack business has accelerated consistently over last 3-4 quarters as we have increased the investments in that business. And last quarter, we have grown at about 21% in value and 12% in volume terms, significantly ahead of industry growth. Our culinary business did have certain pricing pressures, which we did pass on to, from the competition side, we did pass on some price reductions. As an outcome of this, you may see that we are growing significantly on volume. We are acquiring more consumers. The volume growth is looking a little muted. We do expect that we should be able to increase the value growth also in periods ahead, because as a first outcome, we have experienced that in this business, our product offerings are very strong, and consumer stickiness once they experience our product is very high. So as we continue to drive volume expansion, we are also confident that this should result in longer-term sustainable growth for the business. On premium staples, as I talked about, our ambition is for now to keep our volume stable. The business has benefited on account of increase in the commodity price versus last year. So we have had a significant 20% value growth driven by increases in commodity prices. Our volumes are more or less flat. Olive oils actually followed a different cycle. Commodity prices cooled down this year because there was a shortage of crop internationally in the prior years, because of which prices had shot up. Prices cooled down, and we had competitively passed the reduction in prices of commodity to the consumer. So it's not a margin impact, it's actually just a price pass-through for the reduction in the commodity prices. And as an outcome of that, we are seeing a strong 12% volume growth in the Italian business, which is mix of pasta and olive oil. But negative is primarily coming in the value pass-through for the price reduction we have on the commodity side. On the spreads business, this is an area of challenge for us. We are seeing decline in both volume and value. We will talk about that in slides ahead. So overall, if I look at most of the categories, we are growing very strongly. Our investments are paying off. And one category, we do have a task at our hands, which we'll talk you through. Moving to slide number 13, on popcorns and snacks business. Again, we have, as I talked about earlier, we have two fundamental pivots here, ready-to-cook business and a ready-to-eat business. Ready-to-cook is in-home consumption, ready-to-eat is out-of-home consumption. Both businesses are seeing very strong growth in both volume and value terms. Overall, our in-home consumption business has grown by our new launches of rupee 20 and rupee 30 pack, which are aimed at driving consumption from an existing consumer by upgrading him. And these two launches have already got about a 10% saliency in general trade within 3 months of launch. this really gives us a positive momentum for volume expansion through our core consumer. Similarly, if you look at in ready-to-eat business, which is out-of-home consumption of popcorn dominantly and new categories like nachos, we are seeing expanded growth of that both through distribution expansion push we are doing in general trade and also investments we are doing on e-commerce marketing for expanding this business. Moving on to slide 14 on premium staples business. I talked about it earlier, dominantly led by commodity price inflation. We have seen a value expansion. Volumes are more or less flat. We are working on models to try and see if we can accelerate the growth in volume in this business, and we will keep you updated as we establish and prove some of these models on how we will take the future direction on this business. Coming to peanut butter or spreads business for us, this business, as I talked about, we have seen volume and value erosion. Dominantly, we are seeing it in modern trade, which is organized modern trade and standalone modern trade. And there have been entry of many new players riding on a protein wave in the segment, which have specifically talked about protein benefits. And of course, there is also pricing pressure from the existing players who were operating more in the family consumption segment like us. They have, with the onslaught of new players, also resorted to pricing pressures. We have looked at our business very, very strongly. We have developed multiple new products in our pipeline, and some of those are getting launched in the period we are speaking now. And this pipeline is really critical and for us to gain that, recover our volume share from the competition in the period ahead. What we have been able to positively establish is by investing on our brand harder and sharper on the existing portfolio in e-commerce, we have been able to demonstrate a very strong 59% growth. And as we replicate our innovation strategy and invest on mass media and in distribution expansion, presence in modern trade for the full expanded range, we are also confident that we should be able to turn this business around in coming quarters. Coming to slide number 16, culinary. Here, culinary, I am talking primarily ketchup, sauces, and mayo or emulsions business. As you can see, this business is a very competitive category. Del Monte is a challenger brand, but has a significant headroom for market share expansion. So our focus is on expanding our market share and growing our business. As an outcome, we have stayed competitive in this category, and by being competitive on pricing, we have also gained significant volume share, both in consumer-fronted business, which is strong in ketchups and sauces, and also food services or B2B business, which is very strong in our mayo category. We are also looking at leveraging the Sundrop distribution network in the period ahead to expand the growth in this business. Coming to slide number 17 on an Italian business. Here I am talking more in volume growth team because as I talked about, olive oil did see commodity prices softening and competition and us have passed the benefit of that to consumer. There isn't a margin impact of that. It is primarily to make sure that our volume continues to grow, and through that we have made sure that we protect our margins as also we grow volumes in this business significantly. So pasta business, which hasn't seen much of shift on the commodity side, is growing both on volume and value terms, driven by our investments in modern trade and e-commerce channel. And olive oil business has declined in value but has grown handsomely by 18%, driven by our investments in e-commerce, modern trade, which is where this category is very salient. Coming to e-commerce business team, we have invested. I'm on slide number 18. We have invested significantly on e-commerce performance marketing across quick commerce and hybrid platforms. And as an outcome of it, both businesses are reflecting very, very strong growth in e-commerce channel. And this is, of course, a future and emerging channel which is seeing increasing saliency. So in a channel which is seeing increasing saliency, we are delivering a very fast growth, and that also gives us a greater confidence on our business dynamics ahead. Coming to slide number 19, I am on brand marketing spend slide. If you look at, I did talk about it, we have invested and we will continue to create opportunities, create business profitability and margins to be able to invest on sharper growth of our business. We have invested very, very strongly, growing our marketing investments by almost 58%. 40% of those investments have gone behind media, both TV and digital media. We have in fact significantly increased our investments on digital media, as also on e-commerce channel, both in terms of performance marketing and also driving traffic. As a combination of this investment, we have seen significant accelerated growth momentum in all channels of the business. Coming to slide 20. Now, slide 20 is the reported financials. They are not in true sense comparable, so I will not spend too much time on it. Just to give you a heads up on this, quarter one is a combined entity business of both Sundrop Brands and Del Monte Foods in FY26. But in FY25, it is only the Sundrop brand business, and hence the two numbers are not really comparable. For all of you, we have put comparable pro forma financials in slide 21, so I'll move straight to slide 21. Overall, I talked about it. Our top line, driven by our marketing investments, has grown at about 12%. Our material costs have increased, so there has been a commodity inflation. Having said that, we have been appropriately give consumer price increases or drop grammages to make sure our material margins stay constant. This you can context it with a lot of news you may have heard from our competing peers. Most of them have experienced pressure on the material margin side. We have been able to hold on to our material margins. But our other expenses, which is a combination of manufacturing, logistics, selling and admin expenses, we have been able to really look at them very closely and make sure we drive efficiencies in our business. And as an outcome of that, our gross margins have improved by about 110 basis points in this period. Our employee benefit expenses, I would like to call out, we did roll out an ESOP scheme in June, and there is a charge in the month of June of about 15 million, which is a non-cash expense for the ESOP grant we have made to about top 4% of our talent between the two organizations. And our advertising and promo expenses, I talked about, we are investing for growth, so they have seen a substantial investment expansion, which we believe strongly is very critical for long-term growth of the organization, and that will help us drive scale. So overall, as an outcome of this, at a reported like-to-like basis, our EBITDA has grown by 9%. Our EBITDA margin is at 3.7%, much like last year. Having said that, there are two expenses I would call out again for your reference. One is the ESOP expense, which is a non-cash charge of 1.5 crore in quarter one. And second is some of our cost improvement projects which we are running in the business have taken, we have put in some one-time advisors on board who are helping us drive these cost improvement projects. So these are one-off expenses which are of the nature of 1.1 crore in quarter one. And if I actually take these out, our normalized EBITDA for the quarter would have been 16.3 crore, which is about 4.4% of sales. And that is growing at about 30% versus last year. So that's in sum our quarter one financials. Coming to the last slide, slide number 22, just a quick reminder for our thesis behind this platform and how we are looking to build this platform going ahead. We do have a stable of well-known brands which cater to our vision and mission of serving our modern evolving consumers with delicious innovative offerings. We do have a portfolio of offerings within these three brands which ride on the mega consumer trends which are driving the consumption of packaged foods, the segment in which we operate in. We also have presence in all high growth and strong margin categories. In some of them, we have leadership position. In some of them, we are challenger, but we do have a significant headroom and the equity of brands to expand our market share. We would continue to make strong and significant investments on driving growth, accelerating our growth momentum, while at the same time making sure that we keep a very capital efficient approach. And that's why when we do experiments or we, let's say, would get into newer areas of investment, we would follow an approach to test it and based on the tests, scale it up to the next level. So capital efficiency, whether we enter into new categories or we take a position on expanding any business, will remain at the heart of our business fundamentals. Last, and this we have talked about, and this is still an early part of our journey, we do have very strong complementary channel between the two companies, both in terms of brand portfolio and also in terms of sales and manufacturing setup, which can help us leverage strengths of each other to drive an accelerated growth of the business. And as an organization, we do have a very strong management team sitting with me and also working day in, day out in the market space to make sure that we drive growth, we improve our profitability, and create significant value for all our stakeholders. Thank you. And now I will give it back to Ajay so we can open it up for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi team, good afternoon. Just wanted to understand on the Del Monte portfolio, just like when you took over the Sundrop business, you decided that there are certain products which you would defocus on, like chocolates, for example. So is there any part of the Del Monte portfolio which is similar in nature that you want to defocus this? And if so, can you give some details as to what it is, what is the sales contribution of that part, etc.?
Thank you, Percy. Thank you for your question. We do not have a portfolio in Del Monte which we would want to exit. Having said that, there is a portfolio which we would want to invest on in our business. So I've already talked about the portfolio which we will invest on for growth. That's a combination of our culinary business, which is ketchup, sauces, mayonnaise, and similarly our Italian business, which is a combination of pasta, olive oils, and pizza pasta sauce, etc. In addition to this, we have business in chocolate sauces, which is small, but we will sustain it. It's a small business, not very large. We will sustain it. We are not looking to harvest it. We have a business in fruit drinks, which is a canned fruit beverages business. And we also have some packaged food business. All of them operate in niche spaces, I would say, because fruit drinks is a canned fruit drinks market. Not very large, but we have a sizable presence. Chocolate sauce is primarily a two-player category, dominantly in the organized space, so not very competitive. Again, not as large also. That's why we are not looking to invest there. And third, which is the area of packaged fruits and vegetables or canned fruits and vegetables. Again, a smaller market, but we have a position of dominance in a small market, so we'll continue to sustain it.
So two follow-ups on this. One is that what is the for Del Monte overall, what is the split of sales between B2B and B2C? And secondly, these two categories in which you are investing, these two categories are what percentage of the Del Monte top line?
Right. So between B2B and B2C, B2B is about 40% of our business. B2C is about 50% of our business, and we also have a 10% where we do manufacturing for others. So that's the split of Del Monte portfolio. In the categories we are investing, put together between all spaces, we would have close to 70% of our business through these categories.
These two categories which you are investing in, 70% of the total sales?
Yes. I'm talking of minus the contract manufacturing business. Sorry, I'm excluding the contract manufacturing. Yeah.
Okay. Understood. Secondly, wanted to understand that despite the Del Monte acquisition, what I believe is that Sundrop and Del Monte are largely, as of now, run as two separate companies. So when do we see you sort of merging the operations to the extent possible and extracting cost synergies? Because a lot of these, a lot of the functions in these organizations, there are parallel functions running which we don't need to run. For example, sales and distribution to some extent, and the distributors themselves to an extent, etc. So we can extract a lot of synergies both on top line but also on margins by actually merging. And when I say merging, I don't mean the legal entities, but in terms of how the operations are run. So when can we expect that to happen?
So Percy, we are alive to this opportunity. As a management team, we said our first focus is really to look at intrinsic value which is there in two organization. And we do strongly believe that there is an intrinsic headroom for growth in the two organizations on a standalone basis. When I say growth or value creation, I'm talking both on driving top-line growth, which is building scale of individual companies, as also reducing costs or bringing efficiencies. So for this year, our stated, and we have talked about it earlier also, for this year, we really want to understand the business to the last level of detail and understand the strengths of each organization so that we are well prepared as we move into the journey of integrating and building a cohesive organization. So in a nutshell, I would say this year would remain as a standalone business. Next year onwards, we will start getting into journey of unlocking the values by making sure that we have an optimized organization structure. And we also do not take away anything which is fundamentally driving the growth of business, and also deploy some of the resources. See, eventually these are we are a large organization, and we still have a significant headroom for expansion of our coverage, building a more stronger cohesive teams between the two entities put together. So we would get into the journey next year, but we want to go with a very clear understanding of what are the strengths, where do we need to build greater strengths and greater team sizes, where can we potentially integrate to bring some synergy benefits. That understanding we will build in this year and then do the journey in year ahead.
Understood. And last question from my side is that as far as your margin is concerned, I think in the last call you said that for this kind of scale of business, ideally the margin should be in double digits, and we would do that journey over the next few years. So not asking on a timeline or anything, but just asking on what would be the drivers of that margin. Supposing if we have to go from a 4% to a 10% and the 600 basis points has to be traversed. So how much of that can come from the merger synergies? How much can come from a gross margin? How much can come from a operating leverage? Some kind of help us to think about this question.
Yes, so it is a nuanced question. We are also still trying to understand deeply, and at this point what I will say is more directional because we need to still understand it deeply. But broadly, the four levers which will be there for us for expansion of margins, you have called them very correctly. There is a headroom for making sure our efficiencies in the existing business itself are there. And some of them you have already started to see in this year. Having said that, we have deployed that in marketing and because we want to accelerate the growth. So margin expansion on our operations which could be, let's say, I would say about 20% of our total efficiency we are looking to gain, is already being delivered, and that those projects are in progress, some of which have started to give results. Some, as I talked about, will give results in period ahead. Second is synergy, or let's say making sure that we have a consolidated, optimized organization could give between 20 to 30% of our total efficiency, in that range. Growth and scale would again give another 20 to 30% of the efficiency. And lastly, if I have to talk about purely from which is the one I missed here? So I've covered scale, I have covered growth and scale I have covered. I have covered operational efficiency, integration, and on the procurement, or let's say on the cost of inputs, as we call it, material margins. See, that's a dynamic market. I would say maybe 10% could come from there. We do have a fairly competitive cost structure, but through a combination of expanding scale, we may be able to get a 10% leverage coming from our material margins.
Got it, sir. Thank you. That's all from me. All the best.
Thank you.
Thank you.
A request to all participants, please restrict your questions to 2 questions per participant. For more questions, please rejoin the queue. Our next question is from the line of Shirish Pardesi from Motilal Oswal. Please go ahead.
Hi team, good afternoon. My 2 questions, starting from Act 2, we have delivered a very strong growth of 21% value and 12% volume. When I look at the larger growth, which appears to be driven by the ready-to-eat segment, which is you have reported 39% growth. What is it that we are trying to do? Is it that the new product launches, or is it the distribution scale-up which is driving this growth?
So if you look at in our traditional trade, which is the mass market, it is the distribution expansion which is the key driver. We have been expanding business very rapidly in North, and we today have a very big scale presence, while we still have headrooms for growth through distribution expansion in other geographies of the country. So fundamentally for general trade, it is the distribution expansion, and 1 or 2 variants will keep getting added because consumers in snacking business do want choices. So core will be expanding the distribution and keep bringing new variants, sometimes replacing, sometimes adding on. But innovation will play a secondary role in general trade channel. But in modern trade and e-commerce, newer variants, bigger pack sizes, so upgrading the consumers to bigger pack sizes, bigger volumes, as also bringing new variants is the mainstay of growth. And we are seeing good traction on both sides. For example, in e-commerce, our business is almost becoming 3x in ready-to-eat segment. So that's the play.
And just to add, Shirish, to this
Ashish,
question, this is Ashish, right?
Yeah,
so
Ashish.
just to add to this, one integral difference between ready to cook and ready to eat is that the certain flavors are not very conducive to be offered in ready to cook, right? Which are 2 steps. In ready to eat, because you pop and coat and give the product, right? The product experiences are significantly better. So what we have done is we have expanded our offering of flavors also across the 2 formats, and thereby enrolling lot more consumers now onto our franchise.
Okay. No, I was more keen because direct distribution of 5 lakh, I would assume that it will be about 2 times. So our indirect and direct would have been in the range of about 1.5 million. Is it that the correct number?
So potentially we don't track it, Shri, so I can't give you an official figure, but based on my experience of the industry, you are right that indirect distribution could be substantially larger than direct distribution.
Okay. All right. My second question is on staples, which is basically oil.
Sorry to interrupt. Shirish sir, your voice dropped. Your voice is sounding very low.
Is it better now?
We could hear.
Yes, sir, now it is.
Yeah.
Please go ahead.
Yeah. On the staples, I think we have done a lot of reaching in terms of positioning, branding, but the value which we have reported 20%, and volume decline. How much price increases we have already taken in this segment? And if you look at the price pyramid, is it that the premium end is growing faster and the mass is steady, or where this volume decline is happening?
So, see, if you look at 2%, honestly, it's not really a big decline. And if I contour the 2% for you, it is largely in June we dropped, but there was a duty reduction which government did in month of May, because of which trade did hold a position that prices may come down a little. Having said that, most of the duty reduction benefits have gone away with the inflation we are seeing to continue in the edible oil segment. So I would not really call 2% as a volume decline. I would say we are more or less stable. We were actually +2 in April, May. We are minus in June, and hence we have come minus. More importantly, to your question on which segment is growing, I think there is a headroom for growth in both segments. Fundamentally, edible oils, in our understanding, is growing in low single digits of 3 to 5% in volume terms. We do have a headroom to expand our market share. We have not yet taken a position of investing in marketing beyond e-commerce. We would take a position because edible oil is a mass market play. We would experiment. As we speak, we are running a pilot which is going to start very soon in a regional geography. Once we have proof of success in an experimental basis is when we will take a position. We do want to keep a capital efficient approach in everything we do, so we would scale it up based on our success.
Okay. My last question on the popcorn corn sourcing. Do we have enough corn, and if there is any inflation, what kind of inflation, if you can spell out?
Yes, so we do have sufficient storage of corn, and broadly our prices are more or less stable, not beyond 2-3% at best on inflation. And we did talk about grammage reduction we did, so we have been able to actually improve our margins on popcorns a little bit. Not significantly, but we have been able to make sure that our margins, material margins, are stable to better in popcorn.
All right, and thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Bimal Sampath, an individual investor. Please go ahead.
Yeah, good afternoon. Yeah, first question was on Delmont. There were news that internationally they are going through rough times. I mean, so any effect of that international thing on our local this thing, or we are only using the brand name?
Yes, so Vimal, you have in a way answered the question. Yes, we are using only the brand name. Our operations are completely independent. Yes, some of the US subsidiaries are going through a difficult time, but Del Monte globally is split into multiple entities, some of which in US operations are going, but our operations are completely independent, and we only have the license for the trademark in India and Indian subcontinent.
Okay, and second thing is, now that we have scrapped some plants and all, so what is our capacity utilization as of now? And are we planning to go for contract manufacturing to sweat the assets better?
Yes, so I'll answer it for two organizations separately. Broadly, at an organization or a group level, we would be between 60 to 70% capacity utilization for most businesses. In Sundrop brands, we do have sufficient headroom for growing our IPC, which is ready-to-cook business. Ready-to-eat business, we may have to gradually expand because our growth is accelerated. Beyond that, in all other categories, for oils we use third party, so we don't have a constraint there. On other categories, like nachos, breakfast cereals, we have a sufficient headroom for growth. So I do not see any capex investments beyond of routine nature, what you would see in a general P&Ls every year in Sundrop business. Similarly, in Del Monte business also, we did set up a new plant in Ludhiana about 3 years back. That plant is scaled up. Today we have about 60 to 70% utilization there also. And we have a headroom for growth for next 2 to 3 years available in Del Monte as well. We are going to use third-party network primarily for innovations on new areas, where we would use a capital efficient approach before we scale up to own manufacturing. And this is a shift we have now in our philosophy at Sundrop Brands. Earlier, we would set up a plant and then scale up the business. We are saying when we now innovate and get into newer categories, newer businesses, we would try it first through third-party sourcing and then expand internally based on the business case and merits of how we are doing in the market and how the sourcing costs compare versus third-party make versus buy decision.
Okay, so that's a very good strategy. No, and just in the interim period, are we going to do some contract manufacturing to earn some income?
So you are saying on our facility in Sundrop?
Yeah, correct.
So see, we are not averse to it, but we don't yet have any headway or leads which say that we can do third-party manufacturing in Sundrop business. But as a thought, we are not. But our business lines, if you look at, are a very specialized chocolate business. It's not something which was a very prevalent large market in the country. We have a coating enrober-based chocolate facility, which is not very large market yet in the country.
Okay. Thank you.
Thank you.
Thank you.
Our next question is from the line of Rohit from Marshmallow Capital. Please go ahead.
Thank you for the opportunity, and it was a very nice and helpful presentation that you did in the beginning of the call. So my first question is on the core categories that you called out in the presentation. In some we are dominant brands, and in some I guess we are challengers. Could you give us a broad market share for each of our core categories, or all of our categories, or some sort of a market position to understand the scale that we are in today?
So in many of these businesses, we do not officially have tracking at our end, but we have management estimates. I can give you a more directional answer. In popcorn, for example, we would believe that we have 85 to 90% share of the overall market. So we are a dominant market leader in the organized packaged foods popcorn industry. And nuancing it may be 90% in ready-to-cook, maybe 75% in, let's say, ready-to-eat segment. In ketchups and sauces, we will have a high single digit, more in the nature of 7 to 10% in that scale of market share in B2C space. In B2B space, I don't have an estimate with me myself. I will need to come back on answer on that. In mayo, we have a very small share in the B2C space, will be low single-digit market share, but we have a very strong 20% plus market share in the B2B space. So our mayonnaise business is a very strong B2B business, but we have a very strong headroom for growth in B2C space. In ketchup, we have a more evenly distributed business between B2C and B2B, and we have a headroom for growth across. In olive oils, our share will be again close to 20%, dominantly a B2C business. Pasta is also for us dominantly a B2C business. Our market shares will be close to 30%, 25 to 30 in that range. Yeah.
Yeah, thank you. This was helpful. Yes. Yeah, sorry, please go ahead.
In peanut spread, our business is strong in B2C, in retail traditional trade, and there we would have close to 35% market share in our estimate. And in e-commerce modern trade, our share may be between 10 to 20% in that range.
So in each of our core categories, we would be in the top 2, top 3. Is that a fair estimate?
Yeah. So popcorn, we are a market leader. In peanut spreads, we will be in top 2. I would think in ketchups and sauces, we are number 3 or number 4, depending on mayo. We are number 4 possibly, or number 3 again. Ketchups again, we have Kisan and Maggi at a much higher level than us, and then we have Biba, us operating in a very similar share space.
Understood. Fair enough. So, do we intend to So how important is innovation as part of the thing? So do you intend to launch a lot of, so we see some competition launching multi-grain pastas and stuff, and some of them extending into Chinese dips and sauces. So is this an important aspect of a strategy, or how do you see this?
It is. So we would want to, of course, leverage the equity of the brand in a good way and hence get into associate categories. For example, in popcorn business, we did expand into sweet corn business because it's contiguous. We did expand into nachos. We are bringing new flavors as we speak in all ready-to-eat popcorns as well as nachos. So there is a work going on in expanding category as also expanding flavors because consumers are today trying out many more new international flavors. So that's there. Similarly, on sauces, we did enter into Chinese sauces space using Del Monte brand. So that also is already in the market innovation. We do work on the B2B side with our partners, and that also is often a source of innovation and new product launches because many times these B2B customers have a specific brief for us to work on. But innovation is part of our philosophy of growth and is very strong teams are there in both organizations to drive innovation.
Thank you. That's it from me. Thank you for the answers.
Thank you. Our next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, team. So my first question, sir, is that, if we look at the history of Sundrop, on the food business side, they've grown at a decent 17-18% CAGR for last many years, and that I acknowledge that it's from a smaller base. But now, since that we are investing heavily on the A&P side, how should we look at the growth, on the Sundrop side? Should we assume 15% plus kind of a growth? And the reason I'm asking this question is because part of that growth was coming from the newer product entries, while now we have rationalized the portfolio and we are focusing only on few of those products. So how should we look at the growth in this dynamics?
So when you are saying Sundrop, Dhwanil, right? I'll just clarify. You are saying Sundrop, you are talking oils?
No, I'm talking the food part of the erstwhile Sundrop, which is Act 2 and Sundrop.
Okay. So you are saying that in a way Act 2 plus Sundrop put together because in the foods business we have two brands now. We have breakfast cereals coming under Sundrop and we have Act 2, which is our popcorn and snacking business.
Right.
So if you look at, we do have continued innovation in this space. I talked about we entering into nachos, sweet corn in Act 2, and similarly we have in peanut spreads, we are launching newer variants in the high protein or new chocolate flavors, etc. So innovation will continue. It's just that we are restricting innovations to certain core categories where we believe we have a strong right to win because brand is already at some stage and can take a stretch plus consumer familiarity is high that consumer would trust us to give very good offerings there. So innovation will continue to drive. It's just that categories are shifting from chocolates or newer brands, newer categories to leveraging the core better of the brand better. Second, investments are going up. So we would want to also through investments on consumer acquisition, and India we know is a significant headroom for growth in the packaged foods market. So that accelerated and increased investment should also drive our growth upwards. I don't want to give a specific number to you. Our position always is that we will grow faster than the market. Our endeavor will be to at least, let's say, 4 to 5% better than the market growth or higher going forward. That's the way we are pivoting, and we will continue to invest for accelerated growth. I don't want to attach a specific number at this point of time, Dhwanil.
Okay, no worries, sir. Sir, second question is on the peanut butter side. I think, this peanut butter market share loss has been the journey started, a few quarters back, even before the new management took over. There were some challenges on the peanut butter side. So in your opinion, what is happening, in that market? Is it that too many players have entered there? And if so, what are we doing in terms of steps to ensure that we regain market share and then grow from there on?
Well, this is Ashish, right? So I'll just take that question. See, on the peanut butter side, if you look at, and it is largely divided between the big pack, which is closer to about 900 grams and above, and smaller consumer packs, which are used as table spread, and a mix between the channels. So you would have seen that we have started now growing faster than the category in e-commerce channel, right? Which we have said on the peanut butter side. Where we do still have a challenge, right, is with the price challengers in the big outlet, big packs, which are the ones which are more commoditized in nature. In that area, we have already started, and we have now product which, as we speak, is getting rolled out, where we will be competitive with them, and we will start taking back our share. But what happens is, because we have been out at a competitive price for some time, it is taking a while for us to build back that share. So on the smaller consumer packs, we are growing faster than the category, where our strength in GT lies. So we are acquiring new consumers and rapidly growing there. We are growing in e-commerce. It is the standalone modern trade and the big modern trade where we still have a challenge and a product price architecture to be fixed. We have done the product. We still need to get the listings and going there, which you will see as we progress. Now, having straddled all three of them, we will start looking at a good volume and value growth coming in as we go forward.
Okay, got it. Thank you. That's it from my side. Wish you all the best.
Thank you.
Thank you, sir. Our next question is from the line of Yash Bajaj from Lucky. Please go ahead.
Yes, good afternoon, and thanks for the opportunity. So when we acquired Del Monte, I think one of our ways of growing Del Monte was to leverage Sundrop's strong GT presence. So where are we in that journey today? That's my first question.
Yeah, so thank you so much for this question. Yes, see, it's still early days. As we talked about it, we did the company acquisition got done only in the middle of February. So we are working on some pilots. Our approach always will remain to pilot and then scale up. So between the two teams, we are working on few pilots where we carry the distribution of their products in a regional geography, see what kind of response we get through that expansion, and what kind of challenges we get from existing trade partners, because there are existing trade partners who are servicing that business in every geography. Once we learn that entire thing is when we will scale it up. So this year will remain on experimentation in leveraging the network of Sundrop for expanding Del Monte business. We will focus on the core categories, which is culinary primarily in this year. Similarly, to put the reverse side, we are also trying some experiments in food service business for Sundrop products, leveraging the network of Del Monte. But as I said, this year will be experimental. Next year we will see scaled versions.
Okay, so whatever growth we are seeing today in Del Monte, probably relatively negligible portion of it would be coming from some kind of GT expansion. Till now, we haven't seen any benefit of the GT expansion.
So in quarter one, there is zero growth on account of leverage cross synergy.
Understood.
Quarter one was completely dependent.
Understood. And is it possible to give the channel mix for both brands, for Sundrop as well as Del Monte for Q1?
Yeah, we can share that separately, but broadly to nuance it, I did talk about, not at a brand level, at a company level, we can share with you. At a company level, Del Monte business, 40% is B2B, which is a mix of food services, key accounts, and a little bit of exports. Then between the B2C business, it is fairly uniformly split between modern trade, e-commerce, and general trade. General trade will be about 15%, modern trade will be about 8 to 10%, and e-commerce will be about 12%. And we have about a 10% business I talked about through contract manufacturing.
Okay. Understood, sir. And so my last question is that I think FY25 the core category was 35% of the entire year sales. This quarter it is 39%. Is there some play of seasonality over here? I'm just coming from the point of view because we are focusing more on our core categories. So if you could help us with that.
No, sorry, I'm not clear of your question. Our core categories is 59% of our business.
Sorry, my bad. Core category this quarter is 61%.
61%.
And
25, 65 this quarter.
And financial year 25 was 65%. So is there any seasonality here or anything you would like to call out in terms of the non-core category basically increasing?
No, there is no seasonality. It's just that intrinsically we are seeing faster growth coming through core categories. So the trajectory is very clear. Core categories were 53 in FY23. They became 59 in FY25, and they are 61 in FY26 quarter one.
Okay, it is 59% in financial year 25, the core category?
Yes. Yeah,
okay.
It was there at yes.
Okay, sure. Okay, thank you. That's all from me.
Thank you.
Thank you, ladies and gentlemen. That was the last question for today. I now hand the conference over to the management for closing comments. Over to you, sir.
Sure. So thank you all. I would not take too much of your time away. We are already well past the time. So thank you for being present and for your wonderful set of questions. As we said, we are committed to drive accelerated growth and improve the value for our stakeholder. As a management team, we would continue building our journey, going from here of working to improve our efficiencies in business, but deploying them sufficiently and smartly for accelerated growth of the business and continuously increasing the value for our stakeholders. Thank you so much and wish you all the best and looking forward to a next meeting also in quarter two. Thank you so much.
Thank you. On behalf of Anand Rathi Share and Stock Brokers Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.